Hello, and thank you for lending your ears to Ratehub.ca's Real Money Talk podcast. In this show, we give you the real talk on all things money. We eliminate the fine print, we junk the jargon, and we explain how you can make smarter financial decisions. We're not millionaires, we're thousandaires, and we know you are too, so this show is for you. We want to talk about money because it affects everyone, rich and poor. Money shouldn't only be the occupation of the 1%, but rather the 99%. Avocado toast ain't the reason you're broke. Don't hold out lattes for paydays. Let's make money an everyday discussion. Thank you for tuning in to Real Money Talk. My name is Tyler, and with me today is guest host, senior SEO content specialist, Haider Owanadi. Welcome, Haider.
Hello. Hi, that's quite a mouthful.
Our guest on the show today is personal finance trainer, speaker, and national best-selling author of books such as Smoke and Mirrors, Financial Myths That Will Ruin Your Retirement Dreams, Enough Bull, How to Retire Well Without the Stock Market, Mutual Funds, or even an investment advisor, and The Procrastinator's Guide to Retirement and a financial guide to retiring in 10 years or less. He is a chartered professional accountant and has been handing out free knowledge and budgeting templates on his website. We're so excited to have him on the show today. Please say hello to David Trahair.
Hi there.
You also say hello.
Hi, Tyler. Hi, Haider.
Hi.
Hey, how's it going?
If you've listened to the show before, or if you're a first-time listener, we always kick things off with a money mistake or makeup. I'm going to go first. I bought a projector off Amazon so that I could have socially distanced movie watching in my backyard. And it was a pretty sweet deal in about $300. It included the screen and an HDMI cable to connect to my phone. And then I was able to watch a hockey game on it through CBC. And so I thought, okay, everything's good. Everything's great. And then I went to watch Netflix on it, and it wouldn't watch Netflix. It wouldn't play Netflix. It wouldn't play Disney Plus. It wouldn't play any of these like copyrighted things. And it turns out that there's something called HDCP compliance, and this budget projector was not HDCP compliant. So of course I had passed my 30-day return window, but I called Amazon because I was like, come on, I'm 1 day past. So she just sort of laughed at me and said, yeah, no problem. We'll return it. So it was very nice. And then I actually got a letter yesterday from the company that said, hey, we want to keep you as a client. Here's a gift card. Tell us what you think of the product. But anyway, so the lesson here, I guess, is keep fighting. If you feel that there is a refund owing, there might be a window for you. Haider, how about yourself?
Yeah, that sounds like a win. I don't know.
That's the money makeup this week. Yeah.
Yeah. Mine's also Amazon related. I had, everything, I guess, because we're all stuck indoors. I had a messed up door in my kitchen, and the hinge was broken. So I'm like, okay, I got to replace it. I go on Amazon and I find a hinge. For some reason, they're all so expensive. I just need two, and it's like $60. So I buy it. Turns out it's like 2 boxes of 60. And I'm like overwhelmed with all this, and they didn't even fit properly. So I had to, and then it turns out I could even call my superintendent, and he did it for free. But I also did return the Amazon package, and I encourage everyone to start returning Amazon packages. I never did it in my life before, but it's totally worth it. And yeah, do it.
That's awesome. I'm glad you tried to DIY. You're ready for that home ownership step.
Yeah, in my tiny condo.
David, how about yourself?
Well, how about I tell a story that's not Amazon related?
Yeah, that's great.
Is that okay? Although I use Amazon all the time. Going back to my earlier days, I mean, I've been around the block a few times. I'm going to be 63 this year. But in my younger days, married with 2 young children, I was trying to start an accounting practice. And when you're self-employed, the cash flow is up and down and not really predictable. So for years, we were credit card revolvers. We couldn't afford to pay off our credit cards. And as a financial type, I knew that was absolutely bad, terrible to be in that situation. It bothered me every single day, but it was just physics. There's nothing we could do about it. We were spending more than we were making, not throwing money away. It's just expensive to raise kids. And it's interesting to me with respect to money, a relationship is so important. What your spouse thinks and does with money is as important as what you do. And my spouse happens to be somebody who is not a cheap tightwad accountant like me. She doesn't really think too much about money and is very interested in making sure that we traveled. I remember distinctly in the early days, and again, I was born in 1958, right? Before cell phones, if you wanted to video record anything like your young children, you had to buy a video camera. So even during that time when we were credit card revolvers, I remember resisting, like, can't swear on a podcast, but resisting her insistence that we buy a video camera that was $1,000. But we did anyway. She eventually convinced me to do that. And now I've just actually digitized all of the 8mm videos of all our children when they were born in the 90s. I mean, how do you value that, right?
Yeah.
So it's, and again, I've been thinking about and writing about money for decades now. It fascinates me how important the human element is, the non-financial element. I mean, you can do spreadsheets, till the cows come home, but what is as important and often more important is the psychological impact of how people deal with money. What's in their genes? Are they naturally frugal? Are they spenders? And I think the message has to take into account what the person's psychology is. So there's my story.
That's a great story. We've had some sort of money mindset people on the show, and the trauma of money and or lessons we learn as children and how we bring them into our adult lives. And now with children of my own, I'm constantly, I actually asked my wife the other day, I said, we need to, reading your book, I said, we need to budget better and plan better. She's like, I'm frugal enough. So it's really interesting how, and then I'm trying to bestow this knowledge that I've, learned, working at Ratehub and reading these types of books onto my children. And, my 4-year-old, I was lying down with her and the other day, and she was just clicking on my phone. She can't read, but she knows it says add to cart. So she was just tapping add to cart. Get out of here. But yeah, it's interesting how that psychology of money works. And it has profound impact on our lives. So Thank you for sharing that story. It's incredibly valuable. So to kick it off, so you've written books about debt and personal finance strategy. What's the inspiration for The Procrastinator's Guide to Retirement? I love this title. And why do you feel this book is important for Canadians? Are Canadians not saving enough? And are we falling behind because of rising costs? Please explain.
Sure. Well, the title of the book was actually given to me by a friend of the family about a decade ago. She said, The Procrastinator's Guide to Retirement. I said, oh, I love that title. It is a bit of a mouthful, saying procrastinator correctly. But at the time, I didn't really know, well, what kind of book would that be? So I wrote a number of other books. And, as I age, I use my personal experience, but also the experience of people that I meet, people that get in touch with me because they've read the book, or as I was telling Hyder, I give courses on personal finance to other CPAs across Canada. And and also obviously reading everything that's in the media about the subject. And while it's very difficult to get hard and fast statistics on it, there is a large portion of the population that is way undersaved for retirement. There's just no question about it. And when we had a couple of focus groups and I sent out drafts of the early book, most people who picked it up said that describes me, right? It's because it's expensive to live, raising kids. Most people don't have $10,000 lying around at the end of February to make an RRSP contribution. They're just struggling to pay the bills. So in many cases, people naturally become procrastinators when it comes to saving for retirement because there's just so many other higher priorities. And I started thinking, well, okay, how can I give advice to people who are in that situation? So the first thing I did was went through all the math, created all these lovely Excel spreadsheets about planning for your retirement, and came to the conclusion that it is possible starting later on in life. And the byline of the book is basically 10 years or less to go to retirement. If you play your cards right, it is possible to crank up your retirement savings significantly in 10 years or less. Now, having said that, I'm not recommending people do that. I'm just saying that if you haven't been able to start saving for retirement, all is not lost. Don't give up. Here is how you can do it. I go through a sample family. I give away a spreadsheet called the Procrastinator's Number Cruncher with the book and the course. And I encourage people just to punch in their own numbers to see what situation they're in currently. Because I think a lot of people, especially those that aren't good with numbers, which is a large portion of the population, they just really have no idea whether they are well set for retirement or not. They just don't look at the numbers. Even those that are good with finances often don't look at the numbers. So that's what I try and do, is I try and encourage them to use this spreadsheet to project from where they are now to when they want to retire. Are they saving enough? And the idea is to essentially give them the information and the motivation to actually start making positive changes to achieve their goal.
Yeah, I just wanted to say that, like, reading the book, it was hard to come up with questions because, like, you kind of like lay out everything and you have like links. I'm like, this is the first time I'm using links when reading a book. And as someone who's not 10 years away from retirement, hopefully, the good thing about I find it very insightful too. Like, I'm 30, I'm probably going to retire in 30 years or probably more, as your book says. And it just really opened my eyes a lot, because I just put money in an RSP. I don't think about it. I don't even know half the insights. We can get into it, but sure. So regardless of where you are in your retirement journey, it's a great book.
I appreciate that. Yeah. I mean, the idea, like, what I do is when I write a book, it's not, I don't like to use sophisticated terms. I like it to be readable by people who aren't, professional money managers, for example. And my angle is that I am not a financial advisor. I don't handle people's money. I'm not licensed to invest for anybody. I am not writing books so that somebody will say, wow, that guy's a genius. I gotta bring my money to him, because I don't do that. My end game is education. So my end game is the book or the course, coming from an independent point of view. And I think, a large part of the information out there is from people with a conflict of interest. They're interested in AUM, assets under management. How much have you got? I'm going to get 1%. I want to go after ultra wealthy people because that's their incentive. That makes them their money. For me, it's just education.
For my first question, what I really loved about the book is opening. It just kind of talks about how when you think about retirement, you should start by tracking your spending. And for me, that's always been something budgeting and not retirement. The idea of tracking your spending for retirement was a new idea. I always thought about it as a percentage of income. So why is tracking your spending so important? And what are the habits that you can get into to continue to track? Because there's so many apps out there, but people continue to ignore it.
Yeah, I love talking about this because My point of view is I don't like the word budgeting. And when people say, "Oh, I want to budget my expenses," well, to be able to budget your expenses, which essentially says list them all and say how much you're going to spend in future, you have to know how much you spent in the past, right? That's the basis. And that's what personal financial tracking does. It tells you where you or your family's money has gone in the past. And again, this goes back to my accounting training. No financial accountant in his or her right mind would attempt to do a future cash flow projection for a business without looking at historical bookkeeping, right? The problem is that nobody is forcing us to track our personal spending. We don't have to track our personal spending for taxes or for any government department. We have to track our business expenses, but not our personal expenses. So most people don't bother doing it. And I try to make the point that if you do it, it's the best possible thing you could do for your personal finances, because whatever you track tends to improve. In other words, you got like an Apple Watch or a Fitbit, you significantly have increased the odds that you will do 10,000 steps in a day because you're measuring how many you've done so far, right? Same thing applies to personal finance. My hope is that people take the time to do it, then actually look at the numbers, and they'll be able to spot it like that. Where are we spending way too much money? Where are we wasting money? For example, if a credit card revolver did that and saw the thousands of dollars that's being added to their debt because of the interest on the credit cards, maybe that might trigger them to think next time they're out spending, oh, well, if we do this, we're going to be paying that much interest. It might spur a change in their habits. With respect to how to do it, I mean, it depends on how proficient you are with computers. I have no relationship with this website. It just happens to be one that I use, mint.com, mint.com. Allows you to link your credit cards and your personal bank accounts and does the tracking for you. Having said that, it requires you to give them your bank account number and your login details, which for security purposes is there's a little bit of risk there. Option number 2 is you could download the information to a spreadsheet if you're proficient with Microsoft Excel. If you have internet banking, it's usually the CSV file, comma separated value file that you want to download. And then you import that into Excel, and then you can consolidate your spending sources. Some of the banks are doing it automatically for their clients. Again, I don't have any relationship with any banks, but RBC has the My Finance Tracker, and TD has the My Spend app. And while I don't use them, I've researched them, and apparently you can have the bank with all the top-notch security that the bank applies handle your personal financial tracking for you. For those that really aren't interested in that or will never get around to it, I encourage people just to do it for 1 month. Just 1 month. Consolidate all your spending sources, even if it's manually, just to see where your family's money has gone in 1 month. Because many people are very consistent in their spending. So while it's obviously better to do this on an ongoing basis, at least if you have 1 month, you get a pretty accurate picture of what your typical spending is like. I mean, it can't hurt to try it. I try and encourage people to spend more time on their personal finances. It's a great investment of time. If you say you're self-employed, you bring in a new client or you get a bonus or something, especially the higher income level that you're at, you're going to lose a lot to tax. Right? Top bracket in Ontario is over 50%, right? But if you can save personal money, that's out of after-tax money. That's much more beneficial than even earning more money that's going to be subject to tax. So again, getting back to personal financial tracking, the best thing you possibly could do for yourself.
I did it for a month. Oh,
go ahead, Adam. No.
I did it for a month and I saw that I was spending so much on Ubers, like Uber Eats and deliveries, and it was kind of shocking. So we decided to cut down our orders to maximum 4 times a week, and that's like a couple $100 in savings per month. And I'm like, well, I got a small raise basically.
Yeah, excellent. that makes a lot of sense.
I read the book Atomic Habits this year, and habits need like a cue point and a reward system. And so if with personal finance, if you say like, hey, I got paid today, therefore it's a cue for me to look at the numbers and look at my past finances or update that Excel spreadsheet. It doesn't have to be one big task. You break it up into small segments, and so maybe it's a couple of hours the first time you do it, but 15 minutes each subsequent time. But then you also need a reward at the end of that habit too. And the reward, I mean, Hyder's just found his reward to keep doing it, is like, hey, look, I found an extra $200 this month that you can put towards, RSP, TFSA, or mortgage, or whatever you're saving up for. Which actually segues nicely into my next question for you, which is, so RSP versus TFSA versus mortgage, which one do we pay first? I know you talk about it in the book, but to the person with their headphones on listening right now, can you give some quick insights into how one should best evaluate where their money should be spent?
Yeah. The first thing I would say with respect to any financial decision is begin with the end in mind. 7 Habits of Highly Effective People, Stephen Covey, amazing book, highly recommend it to people. But what we need to do before giving advice or thinking about what the best option is, we need to think about what's the end goal here. What's our sort of short-term, medium-term, long-term goals with our finances. So let's start with RSP versus a TFSA, a tax-free savings account. If you're saving for retirement, say you guys have like 30 years to go before retirement or more, significant period of time, an RSP is usually the best vehicle for that because marginal tax rates are working in your favor. For example, RSPs work well when you're working, you've got a good job, you're paying good amount of taxes, you make the RSP contribution, it's tax deductible. You get whatever your marginal tax rate is back from your contribution. And then when you retire, you're going to be in a lower bracket and you're paying less on the withdrawal. So ideal situation for an RSP when it comes to retirement. On the other hand, however, say that you don't own a house yet and you're thinking about saving a deposit for a house. That's a much shorter term goal. And in that case, a TFSA, a tax-free savings account, is probably a better vehicle for saving. Because say you're in your 20s, you're sort of in a lower income job, and then 10 years from now, when you've built up the down payment, you're going to buy the house, you're in a higher bracket. So then your bracket's going from low to high. RSPs don't work too well for that. So a TFSA is a better investment in that case. Then we could get into, well, what types of investments to put your money into. But the other issue is you mentioned paying down debt. In my first book, and my first book came out like 2 decades ago, like 2001. And my religion was, if you can afford a house, not everybody can afford a house, right? But if you can, paying off the mortgage by retirement is like job number 1. It's the most important thing you should do. I have actually softened on that because if you do that, you devote every resource you have to paying off your mortgage at retirement, and you've saved literally nothing, you're going to run into severe cash flow difficulties because most people cannot survive on Canada Pension Plan and Old Age Security, the government pension plans alone. So I've softened my attitude to say, well, it needs to be a balancing act, right? If you go into retirement and you've got some mortgage still owing, that's not the end of the world, assuming you've also saved money to help finance your retirement. The other issue, which is fascinating, and again, Ratehub has all the details on interest rates, but with interest rates being so low, the advantage of paying off debt is much less than it used to be. Like in the 80s, when prime was like double digits, 15%, you could get a GIC paying 15% a year. Paying off a mortgage that was similarly at double digits. I know mortgage rates in some years were like 19% a year. You got an amazing return off paying off a mortgage at that high interest rate. Now, I know somebody who got a 5-year term mortgage at 1.6% a couple of months ago. It's, practically, quote, free, right? So the problem I see is with this ultra low interest rate environment, it is discouraging people from saving because you get a paltry rate on things like GICs, and it's encouraging people to borrow because it's so cheap to borrow. And that's the problem. Interest rates are either high, medium, or low for savers and borrowers. It's consistent, right? So to get back to the issue of RSP versus pay down the mortgage, well, say this individual got a mortgage at 1.6%. If he pays that off, he's going to make an after-tax return of 1.6% by not having to pay that interest. Well, can he beat that rate in an RSP? Well, with what the stock markets have been doing, easy, right? Easy. But we don't know how long that's going to last. That's the problem, right?
Yeah, it's too true. It's too true.
Yeah. I mean, the stock market will crash. It always has done. We just don't know when. And I mean, again, I track this for my books and my courses, but the stock market, and again, the danger of saying stock market is we need to really qualify what that means. The Canadian stock market, as measured by the S&P TSX Composite Total Return Index, which is something like 230 of the big public companies in Canada all grouped together. That index in 1 month, if you remember at the beginning of the pandemic, it lost 37% of its value in 1 month from February 20th, 2020 to March 23rd, 2020. Everybody thought the world was ending, right? So everybody was panicking, selling, and all of a sudden it started coming back. And it's been doing this ever since. So that I just checked this yesterday, that index is 11% higher than the peak of 2020 before the crash. So not only has the whole crash been recovered, it's even higher than the highest point right before the crash. And I think part of the reason for that actually is the low interest rate environment, because conservative people who never were in the market before look at the paltry returns they can get on their savings and in GICs, and they say, well, there's got to be something better. There's the stock market. I'm in. And I think that's part of the reason why it's doing so well. The problem is, and again, I've been thinking about and writing about the market and investing for decades. Nobody knows what's going to happen next. I don't care how brilliant they are, what their education is. If they have a terminal and they're working at home and they have 24-hour access to all the financial information, they cannot tell you what's going to happen next. And that's why it's important. Your listeners might have heard of the term diversification. That's why it's important to diversify your investments, because you don't know when the next one's going to crash. You don't know when the next one's going to take off. And so if you guess and you guess wrong, you ruin your finances. And, for wealthy individuals, the multimillionaires, if they lose $100,000, they don't even lose any sleep over it. That's fine. But for somebody who has like $20,000 or $30,000 to their name, that's going to go towards perhaps a down payment on a house or be the beginnings of their retirement savings, they can't afford to lose it all or lose a significant chunk of it. Having said that, the younger you are, the more time you've got for it to recover. And again, for people close to retirement, the recommendation as to an asset mix is totally different than people who are as young as you guys, right? Somebody who's going to retire next year that has everything in the market is at extreme risk. This market could easily lose 50% of its value in a month or so. We know that, and that's the real worry.
Yeah, I think with GME to the moon, I think a lot of new investors jumped into the market and may have helped it. It's just hopefully they discover the market and say, hey, I should stay here and keep my money inside, not just be like, wait a minute, I lost my shirt, I'm out.
Yeah.
But We'll find
Yeah,
out.
that's the problem with investing. It's basically getting back to behavioral economics and how people think. It's driven by fear and greed, right? The greed phase is now. Everybody's getting in because they don't want to miss all the gains. When it crashes, everybody fears. And the worst thing you can do if you're committed to the stock market is cash out when you panic. That'll just ruin everything, right? Those people who cashed out at sort of the third week of March last year are kicking themselves because if they had just not cashed out, they quickly would have recovered all their money. Amazing as that may sound, and that's the problem. Is with investing, you have to have the discipline to try not to let your emotions run your decisions. Don't get too greedy, and don't panic and sell when the losses come in. Again, the younger you are, the easier that is to do because, as I say, if you needed that money for a house deposit, well, sure, panic is probably the logical reaction. That's why I'm telling you, don't get in the market in the first place. If you've got 30 or 40 years to go to retirement, well, there's much less incentive to panic because if you just sit, it's eventually going to come back. So it depends on your end objective. How long will it be until you need that money?
Actually, I don't want to diverge too much from the questions that we had prepared, but this is on the top of my mind because I read it everywhere on Reddit and it's driving me crazy. And I don't know, it's kind of making me shift my way of thinking. I like true to what you say when you invest, like you need the time horizon. You need at least like 5 years, ideally, or 2 years, or 10 years, or 40 years. But there's always been the thinking of you need kind of like an emergency fund, a stash of cash. Because like when the market goes down or you lose your job, you don't want to, liquidate your investment. But what I'm seeing now is because savings accounts rates, like the best ones are around like 1.25, 1.5%. People are advocating not having an emergency fund at all and using a line of credit because rates are so low as your emergency fund. What's your opinion on that?
Yeah, good question. I've never been a fan of an emergency fund, to be honest, because I find in reality hardly ever do I see anybody with anything in an emergency fund. Let's go back to, well, who are we talking about? Say we're talking about a credit card revolver like I used to be, people who can't afford to pay off their credit cards. Well, they are being charged 20% or more interest being added to the amount they owe. It's effectively an outflow, even though they haven't paid for it yet. To be a credit card revolver owing debt at 20% while having a savings account earning 1% makes absolutely no sense whatsoever. Okay, so those people in that situation probably don't have an emergency fund. But say somebody who doesn't have a credit card balance, should they have an emergency fund? Well, it's a very inefficient way to invest money. If you have it sitting in your bank account earning 0.8% per year, 3 months, generally they say you should have 3 months just in case. That's not a very good investment. I'm not saying it's a bad thing. It'd be good to have emergency funds on hand, but what other priorities do they have for that money? Is it paying down credit card debt? Might it be better that they use that money in an RRSP and then they get a deduction, maybe a TFSA, because they'd have no tax paid on the income that's earned in it? So I think it depends on the situation. I think you made a good point, Hyder, with respect to an unused line of credit is probably the best emergency fund that you could have. I even recommend people later on in life, say the frugal type who have paid off the mortgage, they're retired, they've got ample funds in their RSP. It might even make sense before they retire to open up a HELOC, a home equity line of credit secured by their house, several $100,000 or whatever, just so they have it just for emergencies if they run into cash flow difficulties after they retire. Doesn't cost them anything to have it unused. And then you've got this emergency fund, this emergency line of credit if you need it as a last resort. And again, with interest rates so low, a HELOC rate pretty low at this point in time.
Yeah, like if mortgage rates or HELOC rates went back to 16, 18%, that attitude might change a bit, I guess.
Yeah, could do. But that's another thing. Nobody can predict the stock market. Nobody can really predict interest rates either, although we do have some guidance here, because monetary policy, which is controlled by the central banks, effectively determines where interest rates are going to go. So the Bank of Canada, our central bank, their key mandate is to keep inflation at about 2%. Okay. So if inflation takes off, everything starts becoming way more expensive, they will increase interest rates by increasing their overnight rate, which is basically now as low as it's ever been, 0.25%. That sends a signal to the commercial banks what to do with the prime rate, which is currently 2.45%. And they basically move in lockstep. So if the central bank increases the overnight rate, prime will go up, costing all of us that have variable rate debt to start paying more for that money. And that tends to bring prices down. So the central bank, because of the pandemic, has essentially given guidance that they are not going to increase interest rates for the foreseeable future, probably a couple of years. Although I just read today that they're now softening that and saying it might be 2022 when they start gradually increasing interest rates. So we're pretty well assured that over the next year, interest rates are not going to go up significantly. So our variable rate debt's not going to get more expensive, and we're not going to be making much more in GICs. After that, who knows? Who knows what's going to happen? Nobody can predict that.
So, okay, so we have right now we'll have a HELOC for our emergency fund. Now, in the book, you discuss different investment strategies and who someone should invest with. And I mean, you go into detail in like mutual fund advisors, financial advisors, and you briefly touch on how each of these people differ and what they do. Near the end of that section, you say that the option that will become increasingly popular is to combine the services of a fee-only financial planner with a discount brokerage to do the investing. Why, in your opinion, is this the best method of investing, and why is it growing in popularity? And if you can provide some tips to our listener who may be thinking, holy crap, I need to start investing.
Sure. Well, the whole key with respect to the person that's handling your money is whether they have a conflict of interest or not. And my point has been for a long time is that the person who sells you mutual funds and is only licensed to sell mutual funds has a conflict of interest, because the seller of a mutual fund makes a trailer fee, a trailing commission through the MER, the management expense ratio of the mutual fund, that comes out of your rate of return. Okay, so you're paying for advice from somebody who has an incentive to sell you a product that is bad for you but good for them. So we need to separate the cost of the product from the cost of the advice. Okay, so a full service broker, if you can find a good full service broker, which I have, even though I have this information, I use a full service broker for the bulk of my RRSP, well, how are they getting paid? If they can only sell you mutual funds, we have this conflict of interest. So most full service advisors will use a remuneration method that is a percentage of the average value of your portfolio. So 1% of your portfolio, or maybe a little bit more, maybe a little bit less, per year, you pay them in a visible fee. That then disconnects the product recommendation from the investing recommendation. In other words, if that's the case, they're getting this visible fee. They should not have you in mutual funds that are also paying them a trailer fee. That's double dipping. That's illegal, right? They will then have you in, and again, I discuss it in the book, exchange traded funds or maybe individual stocks and bonds that don't pay trailer fees to the advisor. So that I often say is the ideal situation. If you can find a really good human advisor charging a reasonable fee to have you in products that don't have excessive costs, that's the ideal situation. So in the book, I go on to say, well, not a lot of people have found that person. They exist out there. They're just hard to find. And so therefore I say, well, it's easy to say, okay, well, I'm going to use a discount brokerage account and do it all myself. Most people are wholly unqualified to do that. And even if they are qualified, they are at risk of letting their emotions get control of them. You churn your own account because you read something about that or this. It's good to have another person, another professional to help you, even if you're going to use a robo-advisor account. So what you mentioned, fee-only financial planners are professionals, professional advisors that charge a visible fee, like a set fee or an hourly amount, independent advice. But most of them don't also handle your investments. So that's why if you use that method, you pay the fee-only financial advisor to do, say, a financial plan, maybe pay them a couple of $100 every year to go back and update that plan. They tell you what to invest in, and you actually do it through a discount brokerage account. That's the cheapest way to do it if you can't find a great full service advisor. I was going to say new kid on the block. It's not so new now, but the other option is robo-advisors. And I'm a huge fan of considering robo-advisors, which essentially is an online firm run by humans where a computer algorithm asks you a whole bunch of questions when you open up your account to determine how risk averse you are, what situation is your cash flow, what are your objectives. And the computer algorithm decides on an asset allocation strategy and what to invest in and does all your investing for you. Because it's a computer doing most of the investing, their rates are lower than human advisors, like 0.5% of the average market value of your portfolio, as opposed to 1 or more with a human advisor. And for people just starting out, I think that's a brilliant option to consider. The other advantage of that is most of them don't have minimum account sizes. If you go to try and find a good human advisor, often they have a minimum account size. You need $100,000 or $250,000 before they'll even consider taking you on as a client. Well, a robo-advisor, or a discount broker for that matter, has often no minimum investment value requirement. So you could start with, $25 a month in a robo-advisor account. And, that might be a good entry into the market. You don't have to find a great advisor, which will be difficult because you don't have enough money. And then you get used to sort of with smaller amounts of money. How is this working? Does this make sense? Do I understand it? What's the risk? What happens when the market goes up? What happens when the market goes down? And if the worst happens, you only lost, maybe a few $100 as you're learning. So robo-advisors, there's more than a dozen of them out there. All the big banks have a robo-advisor branch. That might be something worth considering.
Thanks for that. That's awesome. And that's how I got into investing initially with a robo-advisor as well. Like I had a mutual fund guy when I had like $1,000 and I was 25 and then I moved to Wealthsimple, and yeah, it was great. But it's interesting that you're talking about like the human advisor part and like the discount brokerage part, because a lot of the consensus now on investing is if you're investing for retirement, you can buy these kind of ETFs, these all-in-one ETFs that are super globally diversified.
Yep.
And because you can use like brokerages that charge like barely any commissions and you just gradually buy on your own, like the human component isn't always like necessary. What's your thoughts on that?
Yeah, that makes a lot of sense. You're talking about balanced exchange traded funds. In other words, you buy that one fund and they do the asset allocation for you. Very popular these days, very low cost. The human advisor, I think, might be important depending on your situation. I mean, especially if you as you age and your finances get more complicated and you have things like, prenuptial agreements and maybe small businesses that you own, and you're being pitched whole life insurance and things like that. A human advisor is a great resource to have to talk about things other than just your investments. So yeah, as I said, that's usually my first recommendation to people is try and find a good human advisor that you trust that has reasonable fees because of all the other benefits and issues that they could discuss and deal with you that a robo-advisor is not going to want to do. The robo-advisor is not really out there to do that. Yeah. The problem is they're hard to find. I can't point you to a website that says, here's all the bad investment advisors and here are all the good ones. It doesn't exist. So we're left to our own devices. Usually it's word of mouth, right? You know somebody that's a big fan of their advisor. But you can't stop there. You need to do some background checking because I write about Ponzi schemes and things. A lot of people think they've got an amazing investment advisor. Many people raved about their investment advisor called Bernie Madoff decades ago, right? Total con artist. The guy who sadly just passed away in prison, ripped off people for billions of dollars, but was the nicest guy you ever met, or seemed to be the nicest guy you ever met. So, word of mouth is a good place to start, but you have to do some background checking of the potential advisor, even if one of your trusted friends recommends him or her.
Yeah, that's great advice. And on the topic of kind of adjusting your finances based on your situation, you talk about spousal RSPs in your book. You use the Clarks as an example. And that was really eye-opening because I don't use the spousal RSP. And can you just talk a bit about how that can really maximize your retirement savings?
Sure. Well, again, go back to the beginning with the end in mind. When you retire, the ideal situation is that you and your spouse will be bringing in about the same amount of money each year when you retire. So Canada Pension Plan, Old Age Security, RSP withdrawals, RIF, Registered Retirement Income Fund withdrawals after you turn 72. You want it more or less balanced because that'll minimize your combined tax bill. So if one of you has a huge, massive RSP and the other has a very small one, even with pension income splitting, you can only split up to about half of it. It's better to have them about the same value. So a spousal RSP is ideal in a situation where you have one income earner or maybe one high income earner and the other spouse doesn't work or has low income. So a spousal RSP allows the high income earner to make an RSP contribution based on their RSP room and get a big tax deduction, but it goes into an RSP of the spouse. So the spouse will be taking the money out when they retire. And there's a sort of a rule that says you can't do that within 3 years or it attributes back to the contributing spouse. So you have to wait at least 3 years. So the advantage of that is you can more or less even up the RSPs. The non-working spouse couldn't even make an RSP contribution for him or herself because she doesn't have any earned income. She didn't create any RSP room, or he. And even if they could make an RSP contribution, they got no income, so there's no benefit to the tax deduction. So a spousal RSP is worth looking into. And again, this might be an advantage of using a full service broker because I've read more than a few times about people who mess that up. In other words, they get the non-working spouse to open up a spousal RSP. They make the contribution. They've done it wrong. So then they get this assessment saying, well, you got all these penalties because you didn't have any RSP room, et cetera, and they've been doing it for years and then get total mess.
And then, excuse me, you also say with investing, we need to measure our performance. And it's sort of going back to what we were talking about earlier about like setting up like monthly tracking or quarterly tracking of your expenses. And many people like, as you said, and I would probably agree, is like, we don't even look at our statements half the time.
Yeah.
So another quote from your book, according to McKinsey, many investors are underperforming the benchmark of 2% per annum. On a $250,000 portfolio, underperforming by 2% a year over 10 years would cost over $50,000. Mm-hmm. How should we be measuring performance? And then a sort of tied question to that, but is a robo-advisor enough to be using?
Well, with respect to monitoring how well our investments have been doing, I've been saying this for decades, that the firm that's handling your investments should give you that information. And the information you need is your personal rate of return. Okay, your personal money-weighted rate of return, which takes into account when you put money in, when you take money out, as opposed to a time-weighted rate of return. So your money-weighted rate of return. Finally, a few years ago, the regulators now force investment companies to disclose that to their clients, us, but only once per year. So what you need to do is look at your December statement and look for the rate of return and fee disclosure information. Okay, so it's going to tell you, okay, for the last year, your personal rate of return after fees has been, say, 3%. And they also tell you how much money they've earned on your account through visible and more or less invisible fees like trailer fees. So you do a quick calculation. Okay, the fees I paid them in dollars divided by my average balance, say that came to 3%. That's a terrible situation, right? You would have made 6%, but they're taking half your returns away in terms of fees. For those who have a good advisor, they'll probably find, okay, my investments have done maybe whatever. I'm just throwing figures out for comparative purposes, but like 4% after fees, and the amount I'm paying them is about 1%. That's a reasonable trade-off. But if the fees are equal to your rate of return, then I would argue you're way overpaying for that. I mentioned this in my first book 2 decades ago because every year I would say this doesn't make sense. The people handling our money don't have to tell us how well we're doing and don't have to tell us how much they're earning. And many people that I've talked to over like a decade or more, when they actually sit down and look at it, many of them, the money they have now is about equal to the money they put in over the years, like zero rate of return because they're losing so much to fees. With respect to robo-advisors, in my experience with my I have a couple of robo-advisor accounts. They disclose your money-weighted and your time-weighted rate of return on every monthly statement. Okay, so they disclose that information to you. For any of your listeners who are proficient with Excel, there is an Excel function called the XIRR function. So it's equals XIRR, and then you put a bracket, and then the beginning amount and the ending amount cells, and then the beginning date and the ending date amount cells. The XIRR formula will give you your money-weighted personal rate of return for any series of cash flows for any period of time. And that's why I still talk about it in my books, is to encourage people. Once a year is probably not frequent enough. So this will allow you then to say, okay, I want to do year to date, January 1st to April of 2021. What's my personal rate of return been? The XIRR function in Excel can give you that number. So it's your personal rate of return. What the stock market's done, what GICs are paying, these are the benchmarks that you talked about. It is almost irrelevant except for comparing how well you have done versus what you would have gotten without your advisor just buying the benchmark. Okay. And that's what most exchange traded funds do. You can buy an exchange traded fund, an ETF that mirrors this index I've been talking about, the S&P TSX Composite Total Return Index. So subject to a very small fee like 0.1% or 0.05%, really low fees, you can make what this overall index makes. It's called passive investing. A lot of people are a fan of it, including myself. It makes sense. The statistics with respect to actively managed mutual funds trying to beat the index are very poor. Most actively managed mutual funds that have higher fees don't beat what you could have got in the index. So, I mean, fees are not bad. If somebody's charging you outrageous fees and is consistently making more for you after their fees than you could do in a benchmark index, great. But unfortunately, that is pretty rare. Most of them, because of their main reason being their high fees, aren't able to make a return that you could get through a robo-advisor, a discount broker, or a full service advisor that uses ETFs.
Yeah, that was super insightful. And just to step away from investing just a bit, in your book, you do say, interestingly, GICs are one of your most favorite investments. And they kind of do have a role to play. Can you talk about that? Because with interest rates, they do get flagged on quite a bit.
Well, I like GICs because they're totally understandable. and safe, right? You buy a GIC for $1,000. You've got a 2% rate of return. $10,200 you're going to get in a year, right? You can't lose money. Obviously, the higher interest rates are, the better your rate of return is going to be. But simple, guaranteed, especially if you hold GICs in a bank or a financial institution that's a member of CDIC, the Canada Deposit Insurance Corporation. Even if they go bankrupt, subject to terms and limits, one being $100,000 in up to 7 different accounts, you will get your original amount back plus whatever interest is owed, subject to this $100,000 limit. So safe, easy to understand, no hidden fees. That's why I love them. Would I like to make 10% on GICs? Yeah, but you can't. Right now, you can't. But think about what the environment would have to be like for GICs to be paying 10%. Inflation would be going through the roof. The prime rate would be double digits, so all your variable rate debt would be very expensive, which is what it was like in the 80s. I've heard of CPAs, accountants, who literally went bankrupt in the 80s because interest rates were so high on these mortgages. So yeah, fan of GICs because they're simple, easy to understand. I would recommend, and I don't know whether you want to get into this or not, but I would recommend people, personal opinion, stay away from things like market-linked GICs. Market-linked GICs are basically to convince you that, rates are so low on a guaranteed GIC, why don't we link it to what the stock market does and pay you up to this amount if the stock market does well? Not a big fan of that because that complicates the picture. I say with the fixed income portion of your investments, stick safe, logical, understandable, regular GIC. And with the portion you want to put at risk, get into like exchange traded funds that mirror this percent in Canada, this percent in the US, this percent internationally.
Yeah, like if you want to buy a house in 2 years, you don't want to put your down payment in the stock market. You got to put it somewhere. So might as well put it in like a savings account or a GIC, because like you're saying, like you said in your book, like you're going to get returns. The theoretical 8% return on the stock market is all good, but that's annualized over 40 years. Like
exactly.
Next year it could be negative. That's something I think is lost on a lot of people.
Yeah. I mean, I know how tempting is that. Oh, I could make an 8-10% rate of return. I could put more down. My mortgage would be lower. But with potential high return always comes risk that it's not high, it's low or even negative. And that's the risk you don't have when you put it in a GIC or a savings account. Even though the interest rates are low, it's never going to go negative.
I have one last question before we jump into the rapid fire.
Okay.
And it's just for those, if someone has tuned in because they, looked at the Procrastinator's Guide to Retirement and said, they're concerned about it. So tell me about, Canadian pension plan and old age security. Mm-hmm. Even if I'm able to qualify for the $11.75 from CPP per month and the $200 per month from OAS, that's not really enough to afford the $3,000 average of long-term care home, or even the nearly $2,000 to share a room with 3 other people. These costs are only going to increase. Should we be taking more risky investments if we're talking about, safety and security? Should we, cut spending, reduce expenses, downsize the home, and basically, cut my life off so I don't retire in squalor and hope my kids will support me?
It's all about balance, right? It's all about balance. There's people lie on a big scale. There's the ultra frugal, right? Probably 2 accountants married to each other. They buy a small house, pay off the mortgage, never have credit card debt, didn't go on vacations even when you were allowed to go on vacations, save a ton of money, and retire and just can't start spending. So there's a huge estate. They don't have any kids, waste, right? And then the other end, you've got the spenders, the people who are in credit card debt saving hardly anything. In the situation you just mentioned, Tyler, CPP and OAS is the only thing they've got to live on. They're going to run short of money. I think the best we can hope for is some sort of middle ground. So if you are, not the ultra frugal, not a big spender, and you're sort of somewhere in the middle, that's about as good as it's going to get. Don't worry about trying to be perfect. These people are not perfect. These ultra frugal types might be in great financial shape, but I would argue it's not an optimized life, right? They're not, they never went on vacation. Now the pandemic, they can't go on vacation. Okay. No vacations like for years. Hopefully this won't last that long, but so these people need to loosen up. The spenders need to tighten up. If we are somewhere in the middle, that's about as good as it's going to get. As I said, if we're lucky enough to own a house, we have the benefit currently of a principal residence appreciating in value when you sell it. No capital gains tax. The budget just came out and didn't mention anything about starting to tax principal residence capital gains. That is why I'm a huge fan of, if you can afford a house or a condo, that's a good way to go. Ideally, if you pay off the mortgage, because then it gives you options. Say you're at retirement, but you own your house mortgage-free or substantially mortgage-free. You have options then. You could sell and downsize. You could sell if you needed to go into some kind of nursing home. Most people can only afford these expensive homes because they have equity in their house that they can sell. For many of them, it's not because they have a $500,000 RRSP to rely on. So it depends on the situation. Ideal situation is you buy a house, pay off the mortgage by retirement, you've got a healthy RRSP, you're eligible for CPP and OAS, and you're not in ugly consumer credit card debt. Again, that's great.
So if it's okay with you, we'll jump into our rapid fire questions.
Sure.
Thank you. What is in your wallet?
Credit cards.
But zero debt, right?
Yeah, no credit card debt. We still have a mortgage on the house. I would ideally love to be mortgage free. But I'm in a situation where I don't ever want to totally retire. I love what I do. So if I can continue creating on-demand courses on financial subjects and make money selling those courses, why would I stop doing that? So I don't know how much more you want me to talk if it's a rapid fire.
What's a book everyone should read?
7 Habits of Highly Effective People, Stephen Covey. Amazing book.
I need to read that. Yeah. And Jordan Peterson, apparently his 12 Habits something bestseller. Else. I'm not sure, but there's a lot of habit books out there. What was your first job and what did you learn from it?
Assistant tennis teacher. I won't say pro. I was heavily into tennis when I was a teenager, and I remember this is back in the 80s, no, maybe even the 70s. $2 an hour. $2 an hour was my rate. Just to help the pro by sending him balls and picking up balls and stuff like that.
What is a commonly held belief about your industry or space that you passionately disagree with?
Well, as an accountant, all accountants are boring. I disagree with that. We're not all boring.
You're a lot of fun, right?
I try.
If you had one tweet that everyone in the world was guaranteed to read, what would it say?
Wow, that's a good one. I guess it would need to, well, I'll stick to my area of study. I would say stay out of credit card debt if at all humanly possible. I think it's possibly the worst or one of the worst financial burdens you could carry. I mean, say taking out a home equity line of credit with every penny of equity in your home and investing it all in the stock market would be another one that would maybe tie that.
Okay. So what's your number to retire? How much do you need?
Can't say. Depends on the situation. And that's why I give away spreadsheets with the book. With the Smoke and Mirrors book, I have a spreadsheet called the Retirement Optimizer. And it basically asks you all the personal information about yourself, how much is in your RSP, how much you're going to save, what rate of return, how long you think you're going to live, inflation questions, because there's so many, so many factors that go into answering that question. Because the thing is, each of our personal financial situations is as individual as our fingerprints. Everybody's different. So you can't say it's $200,000 or $450,000 because it totally depends on the situation. And I don't want to leave people sort of in the wind there. And that's why I give away a spreadsheet and encourage them to use it to see, to find out what that number is. The problem is you don't know how you're
I was looking at that. Oh, sorry.
The problem is you don't know how long you're going to live. That's what makes it so difficult.
Yeah, I was looking at that question like this is not the right question to ask because this book is like track your spending and then you'll know.
Yeah.
We talked about it earlier in the show, and one of the things like diversified portfolio, yes, but like tracking spending, and you say like RBC's got their thing and TD has their thing, but I mean I've got money in all kinds of different places, and they're not all tracking in this one thing. So it's
Well, that's one of
spreadsheets,
that's one of the recommendations is for people like you that have all these potential spending sources, like 3 or 4 credit cards, 3 or 4 bank accounts, maybe a line of credit. Reduce the number of potential spending sources because you're probably overpaying fees to begin with. And it's a lot easier to track like one main credit card and one main bank account than it is 4 of each. So try and get it under control. Close accounts that you really don't need.
Yeah. Where can people find you if they have more questions, David?
My website, which is my name, TRA, and then the hair on your head.com or the hair on your beard.
Yeah, again, this is discriminatory.
Thank you so very much for your insights and wisdom, David. It's been an absolute pleasure.
Thanks for having me, guys.
Thank you for listening. Thank you to Beat Chemist for providing us with our music. Find him on SoundCloud. I want to sincerely thank you for taking the time out of your own day and investing it in yourself to get smarter about money. Head over to Ratehub.ca to learn more about making smarter financial decisions. If you want to thank us, please leave a review on Apple Podcast and follow us on Spotify. Thank you for listening. Let's help Canadians choose better with their finances.
The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. The views and opinions expressed by Ratehub employees are those of the employees and do not necessarily reflect the views of Ratehub Inc. or any of its sponsors or officials. This is for general use. We're not certified or licensed advisors.
Yeah, we just don't want to get sued.